Welcome back, everyone. Hope you're all doing well today. There's a narrative gaining serious momentum right now that sits at the intersection of social media, digital payments, and cryptocurrency infrastructure. Elon Musk's X Money platform is scheduled to roll out through 2026, and speculation is intensifying across the digital asset ecosystem. Some believe this represents the moment when XRP finally becomes the foundational layer of a global super application. Others argue it's simply another fintech layer constructed on traditional financial infrastructure. Today, we're going to separate genuine signal from speculative noise. Let's begin by zooming out to understand the broader context. We are currently living through a structural transformation of money itself. Over the past 15 years, we've witnessed capital migrate from physical to digital, from branch banking to mobile banking, and now from centralized databases to programmable networks. Every major financial institution now maintains a blockchain strategy of some kind. Central banks around the world are actively testing digital currencies. Payment networks are modernizing their settlement layers. This is not merely a trend. This represents a fundamental regime shift in how value moves through the global economy. When capital flows into a new technological architecture, it doesn't do so randomly or chaotically. It follows liquidity, scalability, regulatory clarity, and network effects. That's the macroeconomic backdrop required to properly understand what X money represents and why it matters. Now place Elon Musk within that broader frame. Musk has never built incremental products that simply improve on existing solutions. He consistently builds infrastructure plays that redefine entire industries. Tesla was never just an automobile company. It was fundamentally an energy infrastructure bet on electrification. SpaceX was never just about rockets. It was about building orbital logistics infrastructure. X, the platform formerly known as Twitter, is not simply a social media network. It is being deliberately positioned as an everything platform that integrates communication, commerce, and financial services. Payments represent the essential foundation of that strategic thesis. X Money is being described as a digital wallet embedded directly into the X platform itself. The proposed features include peer-to-peer transfers, debit card functionality, creator monetization tools, potentially high-yield accounts, bill payment capabilities, and possibly investing features in later phases, all wrapped inside a social interface that already commands hundreds of millions of users globally. That's not a minor product launch, that's a potentially transformative financial distribution network. According to public statements and credible reporting, X Money is currently in a closed internal beta testing phase. A limited external beta is expected in the near term, followed by broader rollout to the general public. The initial launch will concentrate on United States users, with international expansion planned for subsequent phases. The key piece of confirmed infrastructure publicly acknowledged so far is Visa Direct, and this is precisely where the speculation begins to intensify. Visa Direct is not blockchain technology. It operates on traditional card network rails. It uses push-to-card mechanisms to move funds in near real time between financial institutions. Settlement ultimately occurs across Visa's established clearing infrastructure. In other words, the confirmed foundation represents modernized legacy finance, not decentralized blockchain rails. So, if Visa Direct forms the base layer for launch, why does so much speculation persist around XRP specifically? Because people who follow cryptocurrency closely understand something deeper about the long-term architecture requirements. If you're constructing a global super application designed to move value instantly across borders, across currencies, and across asset classes at scale, you eventually encounter the friction inherent in correspondent banking relationships, foreign exchange spreads, settlement delays, and fragmented compliance requirements across different jurisdictions. Traditional financial rails function reasonably well domestically. They struggle significantly when operating globally at scale. That's precisely where digital asset infrastructure enters the conversation as a potential solution. There is circulating speculation connecting X Money to Cross River Bank. The narrative unfolds like this. Cross River Bank has historical relationships with Ripple technology, therefore X Money may indirectly touch Ripple infrastructure, Therefore, XRP could sit at the center of the entire system. But here's the fundamental problem with this chain of reasoning. There is no confirmed, verifiable, publicly available documentation establishing that X money user balances are legally custodied by Cross River Bank in a manner that directly integrates Ripple technology or XRP ledger infrastructure into the core system architecture. Much of the online amplification traces back to social media posts referencing other social media posts. This is precisely how cryptocurrency narratives form and spread. They begin as theoretical possibility. They morph into perceived probability. Then, without actual confirmation, they get treated as virtual inevitability by enthusiastic communities. That doesn't mean integration is impossible or even unlikely long-term. It means we must carefully distinguish between architectural reality and aspirational speculation. Consider Dogecoin as another illustrative example within the same context. Musk has publicly joked and at times more seriously suggested micropayments for content consumption using Dogecoin, small amounts per article interaction, tokens per engagement. This framing fits the platform's cultural identity and aligns with his historically expressed support for Dogecoin. However, Dogecoin's base layer doesn't natively provide deep interoperability with traditional banking infrastructure at institutional scale. It can function through third-party bridges and custodial layers, but it wasn't inherently built as a cross-ledger routing protocol designed for institutional finance. So again, we must ask the fundamental architectural question: what layer would actually sit beneath a genuinely functional everything application operating at global scale? If you're designing a value network capable of handling that scale, you need something considerably more sophisticated than a single blockchain operating in isolation. You need a neutral routing layer capable of connecting bank ledgers, card networks, stablecoins, layer 1 blockchains, and potentially central bank digital currencies as they emerge. That's where interoperability protocols enter the conversation as genuinely interesting infrastructure considerations. Interledger protocol, originally conceptualized to enable value movement across different ledgers the way internet packets move across different networks, was built precisely for that vision. A sender could transmit one asset type, and a receiver could obtain a completely different asset, with liquidity providers in the middle handling the conversion seamlessly. The vision isn't about one particular coin winning. It's fundamentally about connectivity between systems. Now, has Musk publicly stated he is implementing Interledger Protocol, or XRP Ledger, as the foundational settlement layer for X money? He has not made any such public statement. But here's the genuinely important macro question worth considering. If X money achieves domestic success using Visa Direct as its foundation, what happens when it attempts to scale internationally? Cross-border payments remain one of the most significant inefficiencies in the entire global financial system. Settlement delays can extend for multiple days. Liquidity must be pre-positioned across numerous jurisdictions simultaneously. Compliance frameworks vary enormously from country to country. Digital asset rails offer programmable settlement, completing in seconds, and that is consistently where XRP re-enters conversations about global payment infrastructure. Ripple as a company has dedicated over a decade specifically to cross-border institutional payment infrastructure development. It has actively pursued regulatory licensing across multiple jurisdictions around the world. It has built enterprise-level integrations with financial institutions of various sizes. Its core thesis remains clear: serve as a bridge asset facilitating value transfer between different systems and currencies. Whether XRP ultimately becomes part of X Money's architecture depends considerably less on community speculation and considerably more on whether there exists genuine strategic alignment between the two entities. The more pertinent question becomes, does Musk want a globally interoperable liquidity layer from the beginning? Or does he want a domestically compliant fintech wallet product first, with global ambitions to be addressed later? All currently available evidence strongly suggests the latter for Phase 1 of the rollout. That doesn't eliminate the former as a possibility for subsequent phases as the platform matures. Now let's examine why this broader development matters significantly for cryptocurrency adoption. X currently commands approximately 600 million monthly active users globally. Even if only a small fraction of those users engage meaningfully with financial features, that represents one of the largest potential entry points into digital assets ever created through a single platform. Distribution has always been everything in technology adoption, and crypto has struggled, not because the underlying technology is fundamentally incapable, but because user experience barriers and trust deficits remain substantial obstacles. Embedding payment functionality directly into a familiar social environment collapses that friction dramatically. Sending money becomes as intuitive as sending a message. If cryptocurrency functionality gets layered into that environment, even as an optional feature initially, adoption curves could steepen more rapidly than current projections suggest. But adoption volume alone proves insufficient without the infrastructure to support it properly. Consider what X Money must handle if it achieves genuine scale: peer-to-peer transfers, debit card spending, creator payouts, merchant payments, and eventually investment products. The underlying architecture must simultaneously manage regulatory compliance requirements, liquidity management, fraud prevention systems, identity verification protocols, and capital adequacy standards. That represents genuinely heavy technical and regulatory lifting. Traditional banks address these challenges with centralized databases and established regulatory oversight frameworks. Blockchain systems address them with distributed ledgers and cryptographic validation mechanisms. Super applications in Asian markets often successfully combine both approaches. The real substantive debate isn't whether XRP gets integrated on day one. The real debate is whether X Money evolves into a hybrid architecture, combining traditional and blockchain infrastructure over time as it matures. Focusing specifically on XRP's potential role in any such architecture, XRP was designed for high throughput and low-cost settlement processing. Transactions finalize within seconds. Fees remain minimal. The network is optimized specifically for liquidity routing rather than complex smart contract ecosystems. In a world where a super application requires instant value transfer across multiple currencies and jurisdictions, XRP theoretically fits the performance requirements. However, performance represents only one dimension of the evaluation criteria. Liquidity depth, regulatory clarity, existing institutional relationships, and geopolitical alignment matter equally, if not more. Ripple has spent years building regulatory positioning, both within the United States and in international markets. It has secured more licenses relative to comparable blockchain infrastructure companies than most. That regulatory standing matters enormously when a global fintech platform considers partnering with blockchain infrastructure providers. If Musk genuinely wanted to shortcut years of compliance infrastructure development, partnering with an already licensed and regulated infrastructure provider would represent a rational strategic decision. However, potential must be carefully separated from proof. Currently confirmed public partnerships point to Visa Direct and traditional financial processors for back-end settlement and compliance functions. That signals a cautious, incremental rollout strategy, prioritizing proven infrastructure over experimental blockchain integration. This approach mirrors how virtually every significant fintech platform has evolved historically. Build initially on established fiat rails. Introduce cryptocurrency as an optional asset class within the wallet environment. Eventually, integrate deeper blockchain settlement capabilities if consumer demand and regulatory conditions align to make that feasible and attractive. Consider the institutional capital perspective on these developments. Institutional money is not chasing social media narratives. It consistently pursues infrastructure, tokenization of real-world assets, stablecoin settlement layers, digital identity frameworks, and interoperability standards. If X Money evolves into a meaningful distribution layer for tokenized assets, whether equities, bonds, or stablecoins, the settlement backbone becomes strategically critical. Institutions prioritize transaction finality, counterparty risk management, and liquidity pool depth. If any digital asset were to sit beneath X Money's settlement architecture, It would happen because it demonstrably solves a capital efficiency problem at scale, not because cryptocurrency communities campaigned for it on social media. The regulatory dimension deserves serious consideration as well. Financial services in the United States operate within heavily regulated environments. Wallet providers must navigate money transmitter licensing requirements, banking partnership obligations, consumer protection regulations, anti-money laundering compliance frameworks, and potentially securities regulation if investment products get offered. Launching with Visa Direct and established banking partners simplifies that regulatory navigation considerably. Regulators already understand those rails and established risk frameworks exist. Introducing native blockchain settlement at the core layer generates new supervisory questions about custody arrangements, volatility risk allocation, liquidity provision management, and token classification. These questions are not trivial regulatory hurdles. They require substantial legal and compliance work to resolve satisfactorily. From a purely practical regulatory standpoint, beginning with legacy rails represents pragmatic risk management. Once the regulatory perimeter around digital assets stabilizes further through legislative clarity and regulatory guidance, additional blockchain integration becomes considerably more feasible from a compliance perspective. This brings us to realistic short-term expectations. In the near term, X-Money will almost certainly function primarily as a fiat-denominated wallet. Users will fund accounts through debit cards and bank transfers. They will send domestic currency equivalents. They may receive creator monetization payouts. Perhaps stablecoins or major cryptocurrencies get added as optional wallet balance options, but the base settlement layer will almost certainly remain traditional financial infrastructure at launch. That doesn't diminish the long-term strategic significance of the platform. Once users get onboarded into a wallet environment and develop trust in it for everyday financial transactions, expanding the asset offerings becomes dramatically simpler. If tens of millions of users already trust X-Money for routine payments, introducing tokenized assets or blockchain settlement operating behind the scenes becomes exponentially more feasible from both a technical and consumer adoption standpoint. Projecting forward 5 years to imagine what X-Money might become reveals the genuinely interesting long-term potential. Integrated communication, commerce, payments, investing, potentially lending, unified digital identity, embedded financial reputation scoring, cross-border remittances occurring instantly within conversations. At that scale of operation, legacy correspondent banking infrastructure becomes prohibitively inefficient. Liquidity fragmentation becomes genuinely costly. Foreign exchange spreads accumulate into significant economic friction. If Musk truly intends X to become the central financial interface for a significant portion of its user base, he will eventually confront the structural limitations of card network architecture. Card networks possess enormous power and reach, but they were designed and built decades ago for a different financial environment. Blockchain infrastructure was specifically designed for digital native settlement in a globally connected world. That doesn't guarantee XRP becomes the solution. It means that some form of interoperable digital settlement layer becomes increasingly logical as the platform scales globally. Interledger-style routing, cross-chain bridges, stablecoin liquidity pools, or future central bank digital currency. Interoperability frameworks could all potentially play that role. The super application vision ultimately demands architectural neutrality. It cannot remain constrained to a single blockchain. It cannot rely exclusively on a single banking relationship. It must connect diverse systems seamlessly. That's why interoperability protocols remain strategically interesting to anyone analyzing this space seriously. From an XRP-specific analytical perspective, the asset's investment thesis has consistently centered on bridging value between disparate financial systems. If a super application fundamentally requires that bridging capability at global scale, XRP re-enters the discussion naturally based on its technical design characteristics. But without confirmed partnership documentation, it remains a plausible scenario rather than an established certainty. Capital markets price narratives well before official confirmation arrives. If credible signals emerge suggesting meaningful blockchain infrastructure integration within X money at significant scale, digital asset markets could react substantially before any official announcements. Conversely, if X money launches and operates purely as a conventional fintech product, with optional cryptocurrency trading features but no deeper settlement innovation, speculative expectations built around deeper integration may deflate considerably. This analytical reality underscores why disciplined, evidence-based analysis matters so much in this space. Separate what has actually been announced from what enthusiastic communities imagine might happen. Separate confirmed architecture from aspirational speculation. Short-term, expect pragmatism and incremental development. Long-term, expect ongoing evolution as technology and regulation mature together. The global financial system is genuinely transitioning from siloed institutional ledgers toward interoperable networks. Social platforms are demonstrably evolving into financial platforms. Institutional capital is actively experimenting with tokenization. Retail users increasingly demand instant settlement and transparent transaction processing. X-Money sits at the intersection of all these converging forces simultaneously. Whether XRP or any other digital asset infrastructure becomes meaningfully integrated into that architecture depends on strategic alignment between organizations, regulatory conditions evolving favorably, liquidity economics making integration rational, and genuine technological integration proving superior to alternatives. The real insight worth internalizing here isn't about betting everything on a single anticipated announcement. The real opportunity lies in understanding that financial infrastructure is converging with digital identity systems and social distribution networks simultaneously. When communication capabilities and capital movement merge within a unified interface at scale, new liquidity layers must necessarily emerge beneath the surface to support that integration efficiently. Watch the actual infrastructure partnerships being formed. Watch the regulatory licensing activity. Watch the institutional relationships being developed. That's where genuine signal lives amid considerable noise. Speculation is easy and entertaining. Building actual infrastructure is extraordinarily difficult and expensive. Infrastructure quality and adoption ultimately determines which technologies and platforms become genuinely foundational versus which ones remain perpetually speculative. The difference between those two outcomes, between infrastructure that gets built into the global financial system and infrastructure that remains on the periphery, will be determined by technical merit, regulatory positioning, institutional relationships, and execution quality over the coming years. Stay focused on verifiable developments rather than viral narratives. Track actual partnerships rather than speculative community posts. Monitor regulatory developments that create genuine clarity for institutional participation. Understand the difference between what platforms have confirmed and what enthusiastic communities hope will happen. That disciplined approach, separating signal from noise consistently, represents the most valuable analytical framework available for understanding where the financial system is genuinely heading and what infrastructure will matter most when it arrives. The convergence of social platforms, digital payments, and blockchain infrastructure represents one of the most significant financial developments of this decade, and the details of how it actually unfolds will matter enormously for everyone involved.